The Money Café is brought to you by Eureka Report, your one-stop shop for all things finance. To sign up for your free 15-day trial, head to eurekareport.com.au. Now it's time to enjoy today's episode.
Hello, I'm Evan Lucas, Head of Strategy at InvestSMART.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. James, thank you so much for joining us this week. It's been quite an incredible period of time. I think we need to really address, the big thing that's been going on over the last 10 days, which is central banks. Take me through what you saw with the Fed decision, and we're doing this on the 15th of June. So for us here in Australia, it happened this morning. What are your key takeouts from what you saw from Jay Powell and co?
Oh, I'm still trying to get my head around it, Evan. Obviously, the sort of headline bit of news is that the Federal Reserve kept rates on hold, but then they released a set of economic projections which suggested that they still feel there's room for two more rate hikes. And Jay Powell went out of his way at his press conference to sound very hawkish. The job's not done, inflation's barely budged. We need to keep going. No rate cuts for a couple of years was his quote. So what do you make of all that? I reckon that you got to think a bit like Howard Marks, who always says it's silly to try and predict the next rate cut or next rate hike because you'll get it wrong and you won't get the market reaction right either. So think about the direction of travel. I think we're seeing from central banks right around the world, Australia, Canada, and now the Fed, inflation is sticky, rates are going to be higher for longer, and that has lots of ramifications. It means corporates are going to be paying higher debt costs, which will flow through to earnings. Economies are going to be a bit softer. Consumption's going to be a bit softer. And so I think you've just got to realise we're not going straight back to that ultra-low rates world that we saw really between 2009 and 2021.
I'd agree with that. I mean, I when I saw it this morning, I almost could just hear Jamie Bullard. And for those of you who don't know who Jamie Bullard, he's one of the main members on the Fed, who is not just a hawk, he is the absolute epitome, peak, pinnacle, premier hawk out there. He must have been just pulling his hair out with what happened this morning. I mean, they forecasted this. Let's also put that out there. They have been telling the market for weeks that this was likely to be the scenario, that they are, more giving themselves room to slow down. I mean, by the end of the year, you're right to point out the dot plots, which is, again, what they release with regards to what each member on the board thinks is going to be where the Federal Reserve cash rate is going to be, or what we call the federal funds rate, will be by the end of the year, and it's higher than where it currently is. They most of them have it between 5.5% and 5.75%. So clearly that already tells you that as well. And I agree. We're looking at the projections. It's hard to argue. Again, they've been saying this for so long. Go hard, go early. We want to really sort of and this wasn't that. So again, you could make arguments that someone like Esther George, she was really hawkish, but had slightly turned of late. Maybe she was one of the ones to balk with sort of the main core in terms of what's been going on there. So the Fed is interesting. And again, you have to have a good understanding because they are the lead for all monetary markets across the entire planet. So you need to keep an eye on it. I agree with you, though. I don't think they're far from done. And again, listening and watching what the dot plot says and what the communication is that the probability of the US, federal funds rate being in a 3 handle in the next 18 months, I think is very, very low, considering that, as you just said, not only is inflation sticky, their economy is doing better than I think they expected, and they told you that in the forecast this morning. So off the Fed, moving across to the next one, and we'll look across the ditch here and what's going on over in New Zealand, because as we wake up this morning here as well, New Zealand now has entered a technical recession, having contracted by 0.1% in the first quarter. Adrian Orr has been described as shock and awe for his movement to seeing the New Zealand cash rate to 5.5%. How do you look at this, James? Like, what do you take out from this? Because that was always the threat of him going this hard, that this would happen.
Yeah. I spoke to a banking analyst this morning, and obviously Australia's big four banks are New Zealand's big four banks. ANZ has a 30% market share over in New Zealand. And he described New Zealand as a bit of a crash test dummy because they've been raising rates so hard. The economy was always going to hit the wall, and now we sort of see how that shakes out. The interesting thing in New Zealand is where Australia has mainly variable mortgage rates, and so when the RBA raises rates, that is transmitted to the average Australian pretty quickly. The Kiwis, 90% of their market is 2-year fixed rates, just by dint of history. So they've got this weird circumstance where they have a bunch of people who bought houses at extremely high prices, extremely high debt to income ratios in 2021 particularly, who are moving from a 2.5% fixed rate mortgage to a 7% variable rate mortgage. And on the Reserve Bank of New Zealand's own figures, something like 32% of them are spending 60% of their income just to service their mortgage. That is a huge handbrake on economic growth, and it's probably the only surprise is that New Zealand hasn't quite got to this technical recession sooner. But the saving grace for them, Evan, is that there's no sign of a pickup in unemployment. So that the pressure on people to sell their houses, which would really be a big worry for Australia's banks and their Kiwi operations, that isn't coming through yet.
But give it time. I mean, as you alluded to there, that rollover, that 2-year period is technically starting, because I remember seeing that data too. The big peak in Auckland was in September 2021. So
that's right.
The roll-off is 6 to 8 weeks away, with a peak coming in 90 days. And not only that, as you alluded to there, the catch for New Zealand is that they have the same scenario we do, which is that, most people's wealth is tied up in their household asset. And what that therefore does, because yes, you're right, we haven't seen a material change in the overall stress of the economy, but it's there. I mean, it is clearly there. And the other thing I'll probably highlight here with Adrian Orr and what he's done as governor, as hard as he has hiked, he's been that hard cutting in his tenure. If you look at the Kiwi cash rate, it's pretty jagged compared to what has happened here, and he will move the dial to the downside as fast as he moved it to the upside if need be. The catch for him is that New Zealand is very linked to global inflation. Their economy is very heavily in agriculture, and at the moment that's doing relatively strongly from external issues around the world, things like obviously the Ukraine war. So inflation is something that he's fighting relatively hard, not necessarily coming to the fore yet. We'll see what happens, but you're right. It is the test for what's going on here, which brings me to the last part of this discussion before we move on to something else, which is Phil Lowe. We are, 90 days away from the end of his tenure. Everything is suggesting that it is done. Like, politically, it would be very, very hard for the Feds to keep him there. I mean, all the things they're saying suggest that he's going. I had an interview with Kieran Gilbert for Talking Finance the other day and asked him this exact question. And he said, in Canberra, it's pretty clear. But again, it's the devil you know, the devil you don't. How do you see, the end of Phil Lowe's tenure and what comes next with regards to the board?
Yeah, I think it's been interesting, Evan. I think you're right. It's been clear for probably 2 or 3, really since the start of the year, that Lowe's contract wouldn't be renewed or extended. I don't know about you, but I've seen him in person last week in Sydney at a Morgan Stanley conference and watched the Senate estimates pretty closely. I feel he's a bit unburdened. I feel he's going out.
He's like that coach that knows he's done, and he's just like, right, let's throw caution to the wind.
Exactly, and he's sort of saying he's not sort of massaging the message. He's saying inflation's sticky. We've got to do something about it. If we don't, then the pain's going to be worse. And I think he's been really refreshingly blunt about that. with no concern about any sort of political ramifications. So, and that's what he needs to be. I mean, he's right. Just as in New Zealand, inflation's still stuck at 6.8%. It's still too high here. It's still near 7% here, even after the fastest tightening cycle in generations or in history. So this is, I think we've seen an unencumbered Phil Lowe. What comes next? I'm not sure. I mean, the next central banker, the next head of the RBA is going to have to continue a similar message, aren't they? I mean, there's no way around it. Inflation's just too high.
Yeah, so that's the question. And I'm glad you raised that, because the other question that comes out of this is who, right? Who is the person to replace him? He or she, the history shows that, the governor will come from the bank. So if that's the case, you'd have to argue that Michelle Bullock is, absolutely part and parcel the front runner. But again, we've just had the review. The review is going to come into effect sometime in the next 3 years. You have got a growing push for someone external to shake up the culture of the bank as well, and where it sits. Now, the reason I point that out is that, as you just said, what do they do? How do they continue things? Now, they could even continue things harder than what we're talking about. I mean, if you listen to some of the really strong academic world, they're suggesting they're not and haven't done enough and need to actually really hit the brake, not just with the foot, but actually pull the handbrake up as well to get there. So this is why I asked. This is such a fascinating question. That's the devil you know and the devil you don't. And again, if you were to look around the academic world, you were to look around the central banking world for candidates, we are behind in terms of where rates are at. We are screaming blue murder about rates being at 4.1% for good reason, and I absolutely am feeling that as well from a personal perspective. But we are low compared to our global peers, and bringing in a global peer could actually bring in that global thinking. So that's why I think at the moment there's this very fascinating conundrum that Treasurer Chalmers is facing, is that having an additional 3 years for Lowe would put him bang in line, if he was extended, to be when the next federal election is. Now, I'm not saying it's a federal election issue, but again, they can hang a lot of the problems that are going right now on him if he's gone, and the new person comes in and does what they're hoping, which is that they will start releasing rates sometime in the future, which is a clear argument to make because it's going to happen. But it doesn't mean in the next 6 to 12 months that they don't go the other way and actually get higher before they release. So watch this space.
Good point.
Right, let's move on, because I would need to get on to what we also talk about in this, and I'm hoping to make sure that Alan is happy with what I'm doing here. Need to move on to stocks. Who would have thought the robot that is CSL is human and it actually can bleed? What a downgrade. And it's just fascinating to see this company that for pretty much, and I went through this, the last 12 years has upgraded almost every single year or remained flat. This is the first downgrade or significant downgrade that I can remember in a long, long time from the guys coming out of Parkville. Yeah.
And look, there's nothing wrong with CSL's underlying business. Demand's still pretty good. Their R&D pipeline's good. They're doing everything that you've come to expect from a company that proudly sort of thinks 10 to 20 years ahead. So, nothing wrong with CSL. Let's make that clear. What they've got here is an issue, I guess a bit of a COVID hangover. When they need to collect a lot of plasma from humans, particularly in America, and a lot of, particularly down on the border of America and Mexico. That was badly disrupted during COVID. To get the plasma collection going again in a US economy full of stimulus checks, they had to increase their donor fees. Essentially, those donor fees have stayed high, and inflation in the US has pushed up all their other costs, labor and handling and all that sort of thing. And so the margin on plasma, which to be clear, is still above 50%. Pretty
incredible,
handy.
Isn't it? It's very, very incredible business.
But it's not getting back to the 57% that it was pre-COVID. But CSL say it'll get there in 3 to 5 years. They seem pretty nonplussed about it. But this is a stock that has everyone's piled into as a sort of super defensive, particularly over the last 12 months. And as such, as you said, any downgrade, and these are rare as hen's teeth for CSL, was met with some pretty strong selling. I think the stock was off 7% on Wednesday, erasing most of its year-to-date gains. So, look, there's downgrades all over the economy at the moment. Thursday morning, we saw some from Retail Food Group, not surprising. We saw it from Domino's Pizza early in the week. We've seen the likes of Adairs and Universal Store and Baby Bunting with some pretty major downgrades. We saw some awful figures reported out of David Jones in Australia. I mean, declines in some stores of 40% since the last rate hike. So, just like shock and awe in New Zealand's getting the job done, I guess Phil Lowe's rate rises are starting to really resonate with people too.
Yeah, and I would agree with that. And I think that needs to be pointed out very clearly is that I've keep calling discretionary stock sectors the canary in the coal mine, and it's coming. Like a freight train. So you see that as well, and you highlighted all of them. Temple and Webster. The ones to now really watch are what JB Hi-Fi and Harvey Norman do. They are always the last to move, and they're the ones that I think are about to tell you that they too are under pressure. We saw that in their first half reporting. They were seeing in January, they were seeing a 7 to 10% decline year on year. And that didn't include what's happened with 2 additional rate rises that we saw in March and May. So,
Evan, I'd also point out Coles and Woolies, they're not discretionary retail, they're consumer staple. That's generally safer. But they have had a period really for 3 years during the pandemic of strong demand and very little discounting. So do we see their margins under a bit of pressure as we see more promotions and discounting, people shopping down, shopping around and trading down over the next little while? I think that's possible too as wallets dry up.
Yeah, I more than think it's true. I think that's happening. And I think that's the horrible thing that we're discussing with this stock thing, and we just did it with central banks, is that the issue with inflation is the impact it has on your purchasing power. And therefore the impact it has on your choice. You're no longer making a choice about what discretionary item you're going to buy. You're actually having to make physical choices on the staples in the supermarket. That is why it is so corrosive and such a horrible, horrible thing. And the medicine to fix it is so incredibly bitter, is the way I describe it. And that is why this period now, there is nothing here that I can say that will make it feel better, but it will end. It will end sometime in the future. I don't know when. It will happen probably in the next 24 months, but I completely understand that. And before I want to move on to questions because we're running out of time already. James, you and I could talk forever, but just want to address a few things that clearly I've triggered some people from last week's episode. And I do want to apologize for that around sort of the tax. And there was a couple of people that sort of came into it about it. Just want to combine them all together about the stage 3 tax cuts. And I also want to point this out very clearly. I am not a right-wing thinker. The reason I believe stage 3 should happen is because it combined with the first, second, and third stage, it starts taking pressure away from working Australians, which over the next 2 decades will be smaller than those that are retired. So there has to come pressure off personal income tax. The feds cannot continue to rely on personal income tax at it. I understand some of you sort of took offense to how I said with regards to bans of, certain groups of people and they're working. What I was trying to highlight there is that across the board, the upper end of those people are there. I understand there are going to be people underneath that band, and I wasn't trying to have a crack at you for any shape or form of that. But when you look and take 1, 2, and 3 together, those between 55,000 and 150,000 are much, much better off because they don't have bracket creep and removing that. So I do apologize if I said something wrong, and I do apologize if you sort of took offense. It's, in my view, none of it's the correct thing. I actually think it should move to a progressive indexation taxation system. I've said that many, many times before. It's a much more progressive way than doing these stage 3, 1, 2, and 3. But just want to clarify that. So there was a couple of questions there, James, that you missed because I was obviously doing this with Stephen last week, but that's there. So let's move on. And I want to give it to you because you're all over this. This is from Tim. The media in the last week has been about commercial property valuations and then finally coming off in June. We've obviously seen, a major super fund closing it down. I could be wrong, but I had an understanding that commercial valuers are not legally able to write down property values without comparable transactions. If that is true then, and the headlines are also true, should we have already seen lots of reports of actual lower sales? Is that the case, or have I been misled?
No, Tim, you have not been misled. There just hasn't been a lot of actual sales of note. And we finally got one last Friday. 44 Market Street, an office building in Sydney, was sold by Dexus. They got just under $400 million, but the interesting thing was that it was sold at a 22% discount to 1 year ago. So this has been taken as finally a bit of a proof point for valuers and for property landlords to work with. But now I've got a bit of breaking news here. We've just seen Charter Hall come out, Evan, with their latest numbers on valuations, and they have pushed their valuations for their office fund down by about 3.7%. So this is the question. Is there a bit of a lagged effect? And to Tim's point, have we not seen enough transactions that give us a sense of what's actually happening here? I think this is one we're going to have to watch, not just over the next few months, but probably over the next 6 months.
Yeah, I'd agree. And I think, as I said, the fact that you saw a big super fund closing down their property infrastructure fund this week shows that there is now valuations that are being questioned and how they sit there. The other thing about super funds that are quite interesting is that, as James just alluded to, and with Dexus, they are also quite high in holding these kinds of assets, through actually building them. Cbus is a great example. And then obviously leasing the product that they build, what the valuation sits. And that's what's always, you're right, Tim, to point this out. It's always, this sort of valuation is slightly subjective in terms of where it sits. Going to keep moving on because, again, we're running out of time, and I'm going to be a little bit sort of selective here on you, James.
It's okay.
Because I do want to get to a couple of things that sort of are quite interesting. There's been a lot of talk, and this where did it go? Apologies, I've just lost it. There's been a lot of talk over the last sort of period of time around what's going on with super allocations. And this one's from Julian. I'm going to sort of cut it up a little bit. He's got a query about super fund allocations in cash and about the fact that, most super funds have cash running at between 1% and 2% cash returns, but clearly we now have scenarios where cash has moved up to 4 to 5%. What do you think the super funds are going to do over this current period where cash is actually now becoming a much more interesting scenario? That was from Julian. I've cut up his questions a bit for you, but he's clearly asking the question, when does the super fund allocation to cash start to switch, considering the environment we're in?
Yeah, I think we will see probably a bit of an increase in allocations to cash in super funds and in the balance funds because those returns, as Julian quite rightly points out, have moved up from 1.2%. The super funds will be getting much better than that over the next little while. And so I think we probably will see a bit of an increase in allocations to cash. I mean, the saying here, Evan, is that you're being paid to wait and see what happens. And the super funds will be, that's what I imagine, that's what they'll be doing with a tilt back to cash. Although, I'm not sure it'll be a huge tilt, but it will be a tilt back to cash and probably fixed interest as well.
Yeah, I'd agree. And I again, all super funds are always reviewing their allocation. They're always moving towards it. And again, it also depends on where you sit on the risk curve. I mean, if you told your super fund that you're an assertive or a high growth investor, you're clearly not going to get exposure to that anyway. But they are always reviewing it, and again, they will be looking at it from the point of view of what is in the best interest of members, and that needs to be how they look at it. Again, I'm conscious of time, so I want to keep moving because we're running out. I want to get to Sam. Alan talked about an independent board for fiscal policy a few weeks ago. What are your thoughts about establishing a fiscal policy independent/panel separate from the government and the Reserve Bank? During economic slowdowns, they were able to raise spending and lower taxes and vice versa to get the economy into line. Give the board the keys to manipulating GST, core spending levels, corporate taxes, et cetera, et cetera. The government is and has been hopeless. We need economic core reform. Oh, that's a broad question, Sam. I'm going to let you go first. I'm going to let you go first, James, before I jump in there.
I get Sam's theory, but my question would be, would any of these people who have the power over taxes and spending be, say, elected?
Yeah, so that's the question, is it? I mean, and what I want, before I let you keep going, just for those out there, Sam's question was fiscal policy, so that's government policy, not monetary policy, which is the board. So they are different and need to be separated.
But if you had the power over raising spending and lowering taxes, or doing the opposite, depending on economic conditions, that gets you into the monetary policy area. So I don't think we have elected representatives for a reason, and an independent RBA board for a reason. This hasn't been working too badly over the last 40 years, okay? We're having a rough couple of 3 years, but is monetary policy or fiscal policy really, working poorly at the moment? It's challenged because of a period out of the pandemic, but I don't think we need to blow up the whole structure here just because we're having our first real major economic slowdown in 30 years. We've had a pretty good run at it.
Yeah, I'd agree. And fiscal policy should be controlled by the government that you and I can elect, and all of those listening that you and I can vote for. Because again, as Sam pointed out, they do have the keys to changing taxation, and they do have the keys to changing spending. And therefore, although inverted commas an independent board sounds reasonable, they're not necessarily elected officials, or they could be officials that have certain sways in certain directions that you then can't necessarily move. Now, I know I'm saying this with an argument that could be put at monetary policy. Why is the board? Why is the RBA? Their monetary policy is different. That is supporting the underlying governance and monetary supply in this country. Fiscal policy is around the taxation and the services that we require. So it's a bit different in terms of, that's why I would back what James has said. We need to have them voted in and out. And they have, I actually think right now, what excites me about the current government, although Chalmers, for me, I think I really like him. I think he's going to be an excellent, excellent treasurer. Why I'm so happy that Labor's in there right now, and Sam's question was around GST. I've got this theory, and you can argue with me right or wrong, write in questions by all means. No Labor government is going to touch GST because they hate the policy. No Liberal government is going to touch super because they hate the policy, despite the fact that I would argue both of them are really good, particularly super. Super is a fantastic thing. Its ability to actually take pressure off the pension system, I think, unfortunately, has been forgotten because it's that's a discussion for another day. But why I say that is that I think Labor has the ability to get sort of into somewhat of Sam's question, to actually go back to policies that happened in the early 2000s before it was changed by the Howard government, which shouldn't have happened, around how super is taxed. Because we've already discussed before about my sort of apology sort of to what I said around personal income tax. Super has to be part of this, because if we've got an aging population that aren't really paying much tax, that have a super scenario that is very advantageous to them, there has to be something that goes into it. Clearly, it's not going to be as high as your personal income tax. That's not going to be the case. But back in the early 2000s, earnings were done on a progressive tax system and a progressive number, that if you were earning a certain amount, you were taxed at 10%, 15, 20, and 25%. And that, I think, is where reform happens, Sam. It goes away from an independent board. You have government that has the ability to take steps needed to reform tax, reform spending, etc., etc. We've probably got 90 seconds to go with one question, James.
Let's do Stephos's question.
Good idea. After learning about Apple's further steps into banking as well as AI, I want to invest in the company. Can you discuss how this can be done from Australia? Are there any big tech ETFs that you're aware of that are able to do, and what are your thoughts?
Well, yes, you can buy Apple directly from Australia. Most brokers, given the size of this company, most brokers that have international facilities or the ability to buy international stocks will have Apple on their list. And yes, to Steph's point, there's lots of tech ETFs, ETFs for the NASDAQ or AI-specific ETFs that are able to get you a slice of Apple and other companies. This is a really interesting area to me at the moment, Evan. The share price of Apple's hit a record high, and a couple of times this week we've seen incredible rise of the AI chip maker NVIDIA. Tesla's up for 14 straight sessions. I think it's up like 40+% in essentially 2 weeks. geez, there's some frothy moves in some of this tech stuff. That'd be my only word of caution, Stephus.
Yeah, and I would agree. Look, AI is here. I mean, again, the tech heads that are much better at this than me, some of them have some really freaky things to discuss about with regards to what they think AI could do. Some of them think that they could actually, AI could help us make that leap to things that we haven't been able to do. So again, looking at Talking Finance, Steve Sammartino had some really interesting points on that. Some of them think that AI has a 50% chance of actually wiping out the human race, and then some of them actually talk about the fact that AI could actually be the link that we need to sort of fix climate change and things like that. So yeah, I agree with you though. It is frothy. It feels very much like they know that this is the next race, space race, tech race, whatever you want to call it. But it's probably got ahead of itself, and just to always have that in the back of your head. But we unfortunately, James, have run out of time. So thanks as always for listening. Thank you for putting up with me for the last 2 weeks. This has been a fantastic thing to let me do the Money Cafe. Alan and Stephen will join you next week, and then James will be back the week after. So as always, please send in your questions to themoneycafe@eurekareport.com.au. Just a reminder, please keep those questions short and sharp. There were a lot of questions today we didn't get to, and a lot of them are quite long. We just don't have time to read them all out. So please, if you've got a question, just send it in as short and sharp as you can, because it's more likely that we'll get to it than we can't. Until then, I'm Evan Lucas, Head of Strategy and InvestSMART.
And I'm James Thomson, Senior Chanticleer Columnist at the Australian Financial Review.
And we will talk to you soon. Have a great week.